If you look across Africa, you can't miss it. From gleaming new railways cutting across Kenya to massive deep-sea ports popping up in Nigeria, China's economic footprint is absolutely everywhere. For more than a decade, this partnership has been literally reshaping the continent's landscape. But beneath the surface, the very foundation of this relationship is shifting in a huge way. Okay, so what is going on here? For years, the story was pretty simple, right? Massive state-to-state loans funding these gigantic infrastructure projects. But that's changing, and it's changing fast. So the big question is, why is China rewriting its African playbook, and what does this new strategy actually look like on the ground?
To really get what's happening now, we have to rewind a bit. We've got to understand the original plan. It was all about big, ambitious, almost unbelievably large infrastructure projects, all driven by one massive global strategy.
And that strategy? Well, it has a name you've probably heard 1,000 times: the Belt and Road Initiative, or BRI. When it was launched back in 2013, its goal was nothing short of monumental. The idea was to build a modern-day Silk Road, connecting economies and markets through a huge network of new roads, railways, and ports, with Africa as an absolutely cornerstone partner.
And this wasn't just some abstract idea on paper. No way. This vision became a reality, and fast. The BRI produced tangible, game-changing projects. We're talking about things like the Kenya Standard Gauge Railway, the Lekki Deep-Sea Port in Nigeria, and just countless power plants and highways that have fundamentally changed how trade and transport work across the continent.
So how was this received in Africa? Well, the buy-in was overwhelming. I mean, this number is just staggering. 53 out of 54 African nations signed on. They saw the BRI as this powerful vehicle for modernization and economic growth. Just think about that for a second. Almost the entire continent.
But, that era of massive government-to-government lending, well, it just couldn't last forever. Pressures, both from the outside and from within China itself, started to build, and that forced a major strategic pivot.
One of the biggest external pressures came from heavy criticism from the West. This term, debt trap diplomacy, started to emerge. The accusation was that these huge loans were actually a deliberate strategy to gain political leverage over African nations by getting them deep into debt.
And whether it was because of that criticism or other factors, just look at what happened to the money. This chart is incredibly revealing. State-level lending just plummeted. You see that drop? From an average of $10 billion a year down to less than $2 billion. That is not a small adjustment. That is a complete transformation.
So here's the crucial point. It wasn't just one thing. It was a combination of that intense criticism from the West and, really importantly, China's own economic slowdown at home. The old model of just writing huge checks was no longer sustainable. Beijing had to find a new way to engage.
And that brings us to the new playbook. China is shifting away from those direct government loans and is now encouraging its companies to pursue projects that are commercially viable on their own, often using a totally different kind of funding model. And that model is the public-private partnership, or PPP. So instead of an African government taking on a massive loan, a Chinese company comes in and invests its own money to build a project. Then they get to operate it for a set period of time to make their money back, and then they hand it over.
The Nairobi Expressway is the perfect real-world example of this. A Chinese firm put up its own money to build this 27-kilometer toll road. Now they get to run it and collect the tolls for the next 27 years to get their investment back, plus make a profit. After that period, the whole highway gets transferred to Kenya, free and clear. It's a completely different risk calculation. Kenya gets a brand new highway without taking on massive government debt, and the Chinese firm gets a long-term commercial investment. The risk moves from the state to the company. What's really fascinating is that this new, commercially driven approach is also leading to a much more diverse portfolio of investments. We're moving far beyond just traditional heavy infrastructure, the usual roads and bridges.
For starters, take a look at the green energy sector. Now, China has been involved in hydropower for a long time, but this new commercial focus is sparking a huge surge of interest in renewables. We're seeing investment in places like Namibia for its green hydrogen potential, and a much bigger push into solar and wind projects all across the continent.
Another huge shift is happening in manufacturing. And this is where the strategy gets incredibly clever. You have Chinese companies setting up EV battery factories in Morocco, which happens to have free trade agreements with both the US and Europe. This lets them cleverly bypass tariffs. We're seeing a similar logic in Egypt, and massive investments like a Chinese textile project in Morocco that's set to create over 10,000 jobs. And of course, you can't build a modern economy without a digital backbone.
Chinese tech giants like Huawei and ZTE are right at the forefront, building the core communication networks for many African nations. And this isn't just a push from China, it's also a response to the enormous demand from within Africa for the latest cutting-edge technology.
Of course, none of this is happening in a vacuum. Let's be real. This whole economic evolution is playing out against the backdrop of intensifying geopolitical competition. There's a new scramble for influence and resources on the continent, and it is heating up. So let's just break down the competing agendas here. The U.S. is increasingly focused on two things: countering Chinese influence and securing access to critical minerals for its own high-tech and military industries. China, on the other hand, is focused on securing resources and new markets while also positioning itself as a leader and key partner for the global South.
And this competition, it has deep roots. Back in the 1970s, China funded the Dzar Railway as a huge symbol of Cold War solidarity. Fast forward to today, and the U.S. is funding something called the Libido Corridor as a direct counter. And in response to that, China has just agreed to go back and completely rehabilitate that very same Dzar line. It's like a strategic chess match, and the board is literally a map of Africa's railways.
And let's not forget the sheer scale of what we are talking about here. This economic relationship is just colossal. Two-way trade between China and Africa topped $282 billion in 2023 alone. This isn't a side project for anyone. It's a core economic partnership. So all of this brings us to the final and maybe the most crucial question. China's playbook has evolved from state loans to commercial investment. The U.S. and other global powers are re-engaging. In this new era of competition, the biggest question of all is this: how will 54 diverse African nations navigate this incredibly complex landscape to their own advantage and truly shape their own futures?